Hey, everybody. Good morning. Welcome to the webinar. I'm going to give it 2 minutes so that it gives everybody a chance to get logged in. Look forward to getting started. So I'm going to mute myself for now. Be back in just a moment. Again, welcome everybody. Just giving everyone another minute or so to get logged in, and then we will jump right into the action. All right. Good morning, everybody. My name is DJ McClure, National Flood Experts, and this is our webinar, Flood Zone Mastery and Strategies to Create Value and Reduce Costs for Your Clients. I'm honored you took time out of your morning to spend some time with us. So first of all, thank you for that. All of you guys are experts in your own fields, and so I hope that today you get several good takeaways to add to your business and help your clients ultimately at the end. A couple of housekeeping items. We'll be using the Q&A feature. So throughout the webinar, please at any time feel free to drop in any questions, and we'll have a Q&A section at the end that will address all of those. Many of you I've met in the past, and many of you I haven't. So I look forward to some follow-ups after the webinar today to have some post conversation. I'll drop my email in the chat. And by all means, please send me an email. I'd love to have your contact. Love to follow up and get to know you and a bit more about your company if we don't already. So going to turn the camera off and we'll jump right into the action. So if you've never heard of National Flood Experts, just a quick bit about us. We're an engineering firm that specializes in flood zones. So every year we're working to uncover millions of dollars in savings for clients all over the country. We're based here in Tampa, Florida. I've currently done projects in about 45 states around the country and a couple of territories even outside of the continental. Just to give you some quick stats, we've uncovered over 20 million in savings for our clients over the last 8 years. For you quick math real estate gurus, that's a little over 300 million in property value. And we look at a few hundred properties every month and typically find a solution to create a cost savings on, right around 50%. That's been a pretty consistent average across the last several years. Done over 3,000 projects, and proud to say we've made the Inc. 5000 the last couple of years. So just a quick bit about us. We'll be diving today into obviously quite a bit about flood insurance and what's changed over the last 18 months, really getting into some things that we hear pretty often and some just misunderstandings and things that we can help clear up for everyone's flood zone knowledge. We want to talk a lot about how this obviously is affecting the property market and how this can be an offensive and defensive strategy and tactic for you to use for growing your business, helping your clients. And then one of the things I want to talk about at the end is kind of how it all comes together. We have a lot of us on the webinar today from insurance, real estate brokers, consultants. And so really bringing us all together in the end, and then talk about some case studies and how you can kind of really see, the impact of some of these different solutions and some things that may be possible for your clients. So let's jump right into, what's been changing with flood insurance. You've heard the term risk rating 2.0 by now, the modern day NFIP, the National Flood Insurance Program. It's been a little bit of turbulence. That's why I thought this picture might be somewhat fitting. Definitely not smooth seas for all of you guys that are living it day to day. But, as we look at what's changed, the new normal, if you will, it was quite a tumultuous transition when all this rolled out. And so, if you've been in flood insurance before, or if you even really are quite unfamiliar, basically what's happened is FEMA's introduced, some new variables into the equation. And the big question mark in the middle is because there hasn't been a lot of transparency really into what makes the ultimate premium and how it's calculated. Before you could pretty much spreadsheet out a lot of the different cost variables, and even with a couple different variables, you could estimate pretty closely to what the premium would be. So with the new system, the introduction of the replacement cost value for commercial properties, that in itself has just created a little bit of, ripples in the quoting process. And what they've done is really spread out the multipliers across a lot of different variables now. So, things such as number of floors and square foot now have a little bit more of a play. In the past, it was quite an issue with the elevation certificate, pre-firm, post-firm. So if you didn't have an EC, it would hold up the quoting process for post-firm, whereas now you're not required to submit an elevation certificate in order to get NFIP quotes. Now, has that made it better or worse? It's really hard to say. We'll get into a couple examples here in the next slides. And, there's cases where the elevation certificate helps. And then there's other cases where you would expect that the elevation certificate would make a difference. And then FEMA determines their own numbers and they don't even use the data. So it's been really interesting for our team. Our engineers have spent the last 18 months pretty much just breaking down this new model down to the most granular details. And so it's made it to where it's a lot more logical in some ways to be able to predict, how potentially these ratings can be improved and lower the premium. So things like the latitude and longitude is being used. If you've ever pulled a property in the flood map, you probably noticed that map works a little slower than it used to. And then the occupancy type still has a place. Now, this isn't all the variables. There's obviously several others, but just kind of a quick snapshot. So pricing is no longer logical. That's one of the biggest things that I think has really affected the real estate market, especially, is that you really can't even estimate closely anymore because the flood zone doesn't have a direct correlation. The elevation data doesn't have a direct correlation. And so, it's made it to where it's really hard to even give somebody an idea if they're buying a new property. And the thing about the new system is it's really about, accurate details more than ever. There's been, so many assumptions that were put in place during the transition, and that's led to a lot of discrepancies. And, FEMA pretty much made it impossible for any brokerage to really go in and audit every single policy that they had. So when policies were going from the 1.0 to 2.0 transition and their renewal, you essentially had to go in and re-enter every single data point for that policy in order for it to be updated the most possible. You probably had some scenarios where, renewal quotes were sent to your clients with the assumptions that would be for replacement cost value. They were assuming that buildings were one floor, et cetera. Lots of different examples there that you probably saw. And in changing those details, that changed the multiplier of the policy. So it's been really about getting into the weeds. As we see policies every day, the engineers are really auditing, is probably the best word, every single detail that goes into that rating, because that's really the only way anymore that you can really try to help get clients to the best premium possible. And, that's where having an extra resource can be helpful. Everyone's busy in their own right. Obviously, flood insurance, if you're a broker, is not the only line of insurance that you're overseeing. So, that's where we've really come in. And it's having an extra set of eyes to really get into those details. So some teams have that capability in-house, and some teams, really reach out to groups perhaps like us to then help get into the details. But it's really getting into the auditing of these variables, because there has been a lot of policies that carried over, and through updating and correcting some of those variables, it has led to a cost savings for lots of clients. Now, if you've looked at any of the renewals as they've come out, you've seen this new number, the full risk premium, or FRP. I'll refer to it as well today. So the FRP, you want to kind of rethink the way you think about the premium, because the FRP is the true premium for your clients. And so the premium that they're paying today may be a discounted number. And I'll show you an example here on the next slide in a moment so you can see what I'm talking about. But the full risk premium is not something we had in the old system. And we didn't really know in the past what the finish line price looked like for clients. They may just increase every April based on whatever FEMA's increase that they assessed for that category. So with the full risk premium, we now know what the finish line for our clients look like. They're paying $1,000 today, but the full risk premium is $4,000. They're going to keep increasing until they reach that number. But the reason that you want to think of the full risk as the true premium is because, again, you've probably already seen this. Any new policy that you're writing is starting day one at the full risk premium. And if you've had any clients that missed their renewal invoice date and they got past that 29th day, whenever they have to be rewritten, they come back in at the full risk immediately. So we've already seen a couple fire scenarios where that happened. Client didn't pay their invoice and then came back in several thousand higher than they were to start. So, it's all about the details, and we'll show you here with a couple examples. So this is an old policy. This is pretty much what you were used to seeing. Didn't matter the carrier. You'd see an elevation difference here, which indicated that an elevation certificate had been used. And then some just pretty typical variables, number of floors, non-elevated. So again, these are some of the things, elevated versus non-elevated, before, that made a substantial difference, which now may or may not, in some cases, even be as big of a difference. And so we look at what a new deck page looks like. And again, because we have a variety of people on the webinar today, I really wanted to show this because, if you're a real estate broker, you may never put close eyes on these policies. And so similar type building here, other residential, which means there's 5 or more units in that building. So we're looking at how, in this particular case, it lists the flood zone, but realistically, that doesn't even have any effect on the policy. It could be an X zone, which is the 500 year and beyond, or in this case, could be an AE flood zone, which is, one of the 100-year flood zones. But in this case, we can't even tell if they used an elevation certificate because it says FEMA determined. And so the data may or may not have been beneficial, but they felt that their estimations were more beneficial to the client. So that's what the policy then chose to go with. So as we look at some of the key differences here, you can see the replacement cost value. And when I see this at 1.2 million for another residential building, that immediately tells me that the assumption value was used. So a replacement cost value may or may not have been submitted for this property, most likely not in this case. And so it automatically placed the assumption at 1.2 million. And that changed by occupancy type, depending what it was. So how does that change the premium ultimately? Well, it's hard to say in specific dollar amounts, but the replacement cost of this building could be higher, which could make the policy potentially be a bit more. It could be less. So this policy could have an opportunity to be, a lesser dollar amount if the replacement costs were only, say, $900,000 for that building. And again, because it says FEMA determined, we probably assume an elevation certificate wasn't used. So there's potential there that an elevation certificate might help. And so it's hard sometimes because you don't obviously want to just have your clients just spending dollars on surveys if you don't know if it's even going to help. And so that's been part of the process here too, at least on our end internally, is our engineers doing a lot of estimations and running some models internally that we've built to then be able to estimate as best possible, would any data even potentially benefit the policy? And in most cases, it's a combination of variables that even does anything to move the current premium. So looking at the full risk, this is really the big picture in terms of new policies. And this is how it really pertains, especially to the real estate market, is that you can see in this policy, again, this is pretty standard, just like the other residential that we saw on the past slide. You can see they're paying, $13.52 for this policy, which isn't overly unreasonable given it's $500,000 in coverage. And when you look here at the top, you can see that the full risk is actually over $4,000. So that means that this client is going to continue increasing every year, and they've got this annual cap discount that's going to diminish every single year. And we've talked to a lot of people, and this is something that not everyone has even noticed, especially on the client side, having no idea that that's actually the trajectory of increases that they'll be seeing in the next several years. So why is it important to know the full risk premium? Well, it's going to tell you exactly what your client's forecast is going to look like for the next several years. For some business owners, that could be, pretty crucial. You can see here just on kind of a base graph, this policy is going to continue doubling almost every 5 years until it reaches this number just here at the top. So like I was saying before, if, for example, this property were to be sold and another agent wrote a brand new policy, the new owner would come in at this $4,000 amount. Now, we'll talk on a later slide, a strategy that has existed for a long time with changing ownership and the buyer assuming ownership of the policy. It now has more merit than it ever did in the past. So we'll come back to that in a moment. But years ago, if two brokers wrote the same policy, even if it was a new one, in theory, they would get the same number. Whereas now, it's not necessarily the case. So there's a lot of opportunity to help clients in the full risk premium. And let me show you a classic example, one that we're helping a client with currently. So this is actually a condo building. So condos have kind of been their own category in some ways. A lot of the coastal condos have seen actually pretty dramatic reductions in their overall premium costs. This particular client has a full risk that is close to 70,000. You can see right here in about year 4 is when they're going to reach that number. Currently, they're paying just over 40,000. So in evaluating their policy, there was actually quite a few variables that when corrected for the carrier, now again, it's not to imply there wasn't anything done wrong. It's just that some of the data that FEMA had been using was just not accurate to the best level. So in inputting some of these additional new data points, it's actually going to reduce not only their full risk, but it's going to reduce their current day premium, which isn't always the case. So this would bring their full risk premium down to about 28,000. So that would reduce and give them a refund on the current year. But you can see the difference in the two graphs here, how dramatic this is over a 10-year period. Again, condos rarely will have an opportunity to drop their flood insurance, even if they want to. And so looking at how much this is going to cost this particular association over the next 10 years, that's nearly a $400,000 difference. Now, there's numerous examples of things like this that we're seeing. And so this is why getting attention on these policies is so important. So we've got a couple other examples where we've seen policies renew from the 1.0 to the 2.0 system, and mysteriously, their CRS discount just disappeared. Now, for certain parts of the country, this can be 30% plus in a discount. And so again, this was just one of those things that had nobody caught that, it's possible they would have gone on for years, not realizing why their actual policy had jumped so much in cost. And we've actually seen this in lots of parts of the country. There's been several around Florida. We've seen it in a few other states as well. And it's something that we're giving a lot of attention to. And so there's lots of cases like this where, something switched from the 1.0 to the 2.0 system, and because there wasn't so much transparency in every little detail as to why, it was hard to know exactly what made the policy jump unless you were spending just hours and hours looking at all your policies, which realistically nobody has time to do, and the carriers really aren't giving a lot of support in that regard. I'm probably imagining some of you are nodding right now thinking, yeah, I know exactly what you mean. So we've also seen cases where the latitude and longitude of what they're using as the property address actually has even been on the wrong part of the street or the wrong part of the property. And so since that can change the distance to water, we've seen that even make a difference in premium. So it's really about getting to the granular details with all these cases. And again, as we're going through this, please keep dropping questions in the Q&A, and I will answer those to the best of my ability once we get to that section at the end. So, I mean, naturally, we really only have two options, as you guys know. Obviously, we have NFIP and we have the private market. So let's kind of go, pros and cons, because it's not better or worse. You really have to look at your client and have to make a decision together on what seems to make the most sense. For some properties, NFIP is going to be always the way to go. Going in, if it's a new quote, that it's going to be somewhat unpredictable. But then once you have the quote, it's forecastable in the years to come, because you know what the full risk premium is going to be. You can estimate what their increases will then be year over year. And in 99% of cases, rarely is someone going to get non-renewed by the NFIP. Obviously, there are exceptions in those rules. But with the private market, they set their own rules. They may have a fantastic year one price, but you really have no idea beyond year one what the premiums are going to look like. You've seen this with a lot of carriers. Neptune's been really aggressive in certain parts of the country to get business year one, and then year two, you see something like this. So this is a client of ours. It's renewing next week, and they had Neptune. Again, it's not to pick on them. This is just a real scenario where they had $25,000 in premium across 7 buildings. So they're paying, between $3,000 and $4,000 for each building, multifamily garden style. And year two, they get their renewal quotes and they've doubled. One of the policies had gone up to even almost 11,000. And so it's just kind of crazy, right? So from a business perspective, there's no way that you could have expected that. You guys are already seeing this on the property side, of course, but you wouldn't expect to see this as dramatically on the flood side as well. So this really was, kind of throwing this property upside down from a net operating income perspective. And we had a similar case recently with a condo client that actually had been non-renewed by their private carrier. Now, you don't see condos with private carriers as often as you do, other types of real estate. Especially now, I'm hearing that private carriers really aren't even taking on new condo clients. And so this particular client had been paying about $1,500 a building with a private carrier, and then was non-renewed. And their NFIP, because it came in at the full risk premium, they were getting quotes anywhere from $5,000 to $8,000 a building. So it's making that decision in this particular case, like maybe their NFIP years ago wasn't fantastic. But now because they dropped the NFIP and then they came back to it years later, now they're starting at a much worse point than they were before. So that particular case actually qualifies for a MAP amendment, as does this case study on the slide. So both of these particular clients are looking at having the flood zone changed. We'll talk about how that works in a moment, to where they won't even have a lender requirement for the flood insurance. Now, it's important that I say, we're not insurance brokers, right? We're an engineering company. So we don't make recommendations one way or the other. Our job is to uncover what options are possible and then work with the team, which includes you all, as to what may be the best, situation for that particular property. So this condo, despite probably several recommendations, they're choosing to drop their flood insurance because the cost is just too much beyond what their HOA can afford. So you're definitely seeing some of that around the country as well. So why is all this so important, with the current state of the market that we're in? Why are we talking about, flood zone solutions? Everything's increased, as you know. It's kind of the triple, the triple whammy right now with taxes, overhead costs, insurance costs, on the property side. Like, it's really created a tough dynamic for a lot of properties. And so investors are hungry right now for any kind of a win, any kind of dollar savings that's possible. And honestly, flood insurance is, in some properties, one of the few things that might be able to make a massive impact. It's typically not the first thing that's thought of, hence why we're having the webinar today. So just as a quick refresher for everyone, the real estate brokers will obviously know this right away, but for commercial properties, every dollar that they add to their net operating income, for most properties, that equates to about $20 in property value. So as we've got a lot of things going on right now in the debt market, a lot of people coming to the end of their short-term debt, the valuations of the property and the net operating income being at levels to where a refinance is even possible is as important as ever. And so we've got clients that we're talking to right now that are saying, like, they're trying to figure out some way to continue operating the property, and their NOI is not high enough to even be able to refinance. So we've had cases where, you go in and reduce some of the expenses that might get them over the line to where, in combination with other things, it might be able to then help those refis, be possible. And if nothing else, it does help increase their valuation if they do end up needing to sell. So this is where kind of all this equates to, and this is kind of how it all comes together. Flood insurance savings just becomes another value add solution in combination. So let's switch gears for just a second. Let's talk about, some things that potentially could be just some common misunderstandings that we hear often. Again, some of you guys from the survey, extremely familiar. So, I just want to kind of make sure we're helping everyone here with their knowledge. But understanding the difference in the flood zone types, if you see an A or V flood zone, this is what's commonly known as the 100-year flood zones. So there's, AE flood zones, AH, et cetera. There's several others. But nonetheless, anything in the 100-year, this is what lenders are going to require for flood insurance. The X zone, used to be called B and C in the past, if you're familiar. But the X represents basically the 500-year and beyond. And legally, lenders don't have a compliance requirement for anything that's in an X zone. So kind of to the second point there, what causes lenders to require flood insurance? When the Flood Disaster Act was passed back in the 70s, this essentially put a compliance requirement in place for all federally backed loans, which is most loans, right? So it doesn't matter if you're going through, KeyBank or Wells Fargo, if they're writing a loan program that's federally backed and any of the buildings are flagged on the flood zone determination, they are going to be flagged for flood insurance. And so depending on the type of lender requirements, depending on the type of loan program, that's going to dictate what levels, be it 500,000 or beyond, that they have to have for their flood insurance policies. And so a lot of people don't realize that flood insurance policies can change ownership at acquisition. And I mentioned this now and a little bit earlier because with premiums jumping so much with brand new policies, it's now important that we explore this as an option. And I always tell people to look at this. Again, in the past, it didn't matter because the new broker could write a policy with Assurant when maybe the seller's policies were with Selective and the numbers were the same. Whereas now, what you're looking at is that if someone's got, like the example we looked at earlier, that $1,350 price point for all their buildings, the owner can then start the new owner can start at that price point, and they're only going to see that 18% increase every year as a result. Whereas if their broker or anyone on the team is unfamiliar and a new policy gets written, that owner is now starting at the 4,000 price point for the same property. So it's an opportunity to really help clients. I think this has, a really big importance to at least be looked at. There may be cases where You might see clients keeping their flood insurance with the seller's broker, which is obviously not ideal in most cases, but sometimes that is going to be what we've seen the best way for them to maintain that other price point. These are usually things that we're not involved with, but things just that we see. It's always curious if this does happen, as I'm sure most companies will have access to most carriers. So again, just something to be aware of. And then also, it's not always known that lender requirements can be changed. So again, back to the type of flood zones, if anything changes a flood zone to where it's no longer in an A or V flood zone, so now it's part of an X zone, maybe the maps for the local county updated, or it was, something done for that property specifically, with the letter of map amendment, which we'll talk about in a moment. At that point, the lender no longer has a requirement to pass on. Once it's in an X zone, the flood zone determination documents would then show that. And believe it or not, if you've ever seen one of those documents, it's just a simple yes, no. Is the property in a special flood hazard area, AKA 100-year flood zone? Yes or no. And if yes, required. If not, then your client at that point can obviously still keep flood insurance, but they're no longer being dictated at the levels of their lender. So you could imagine for, types of loan programs that want full replacement value or business income, that can be pretty dramatic change. So just a quick snapshot here. If you've never seen a flood map, this is what you're looking at. The orange area on the left, this is a 500-year flood zone. If I had zoomed out a little bit more in the picture, you'd see that just a little bit to the west, it was no color at all, which is just beyond a 500-year. The blue area you're seeing, this is a 100-year flood map. And if those numbers are probably hard to see depending what you're, watching the webinar on, but that flood elevation at the top starts at 68.5. And then by the time you get to the bottom, 67.9, so it's quite a variation from north to south. And in this red area you're seeing on the side with the stripes, this is what's called a floodway. Floodways are dictated by the Army Corps of Engineers. Typically, it's very difficult to develop in those areas, almost impossible, because nothing that can be done that could possibly affect the flood zone elevation for those areas. So just a quick snapshot. But switching gears as we move into, talking about flood zones and flood insurance as an offensive and a defensive strategy. So something that I talk to a lot of people about around the country, because I think that it's not an area that always gets the type of attention that it may require. And so thinking of flood as a value add strategy, it's not something that most investors would list as one of their value add plays for their property, unless maybe they've already met us, because it's something that we talk about. Whereas if you can find flood insurance savings for your client, it's typically not something that they had planned for in their business plan. And so at that point, it's bonus NOI growth. Again, NOI is for net operating income. So it's bonus profit that immediately hits their property valuation day one. If you can take some bonus NOI to any of your property owners, they are going to love you. So property owners, they want to win. They're looking for anything right now. And if you can take them something like this proactively, then they will definitely be with you for the long haul. So it's all about diving into the details and getting an extra set of eyes on the data. We all have our expertises. And I think having a team of people that you can use to work together is really how you find and uncover these kinds of things. And so it's about getting eyes on these deals and getting to where you can find some of these solutions that are possible. So what are some of the strategies that you have, at your disposal? Well, a letter map amendment, if you're unfamiliar, this is a process where new engineering information is introduced to FEMA to where individual buildings are removed from the flood zone. And so a LOMA, as it's commonly called, will then take a property from the 100-year flood zone and place it into an X zone. This is where lender requirements are no longer being placed on the owner. And so this is valid for the life of the flood map. Most flood maps only update about every 10 to 15 years in most cases. Unfortunately, because the flood zone's not a multiplier any longer, Aloma used to immediately lower the flood premium, switching them to X zone policies. The X zone policies had standard pricing in the old NFIP model. Unfortunately, they don't any longer. But honestly, the majority of clients that we see will still maintain their flood insurance even once they've gotten Aloma, because there's so many domino effect benefits that come from it. Whereas they're not required, that transfers to a buyer that has benefits in the refinance situation. If they've got high flood insurance costs and maybe they do choose to drop their policies, this only makes for a bigger cash out refi. We'll talk about that in a later slide. But just seeing if the MAP amendment is possible is the first step, because if it is, then you can talk about what the different benefits might be and does that solve a problem for your particular client. We probably do, I would say, several thousands of these all over the country, to where no one had any idea beforehand that it was even a possibility. And sometimes it's in areas that you wouldn't expect. It's not always on the edge of a flood map because, as we learned years ago, the world's not flat. And so you have properties that essentially are the outliers, but the flood zones kind of mapping huge areas all at once. Large buildings or large quantities of buildings get all mapped in together. So this is one strategy to look at. I recommend on every property that someone's being required. So the next step is obviously trying to lower the flood insurance today using the engineering review as another way to do that. Obviously, you've got the private versus NFIP type options. You guys have expertises as well in trying to work the policies as best possible. And then it's taking an extra step using other resources to then start auditing some of those engineering details that may be going into the policy as well. And all this leads to, obviously trying to attack that full risk premium, because if you can lower that number, as you saw on the graph, this is dramatic savings for any of your clients that are going to own properties for, multiple years. So I'm a big proponent of the team approach, the whole commercial real estate team, right? This is brokers, lenders, insurance, other consultants, risk management teams, asset management. This is everybody, right? I think it's everyone's job to get some early attention on the flood zone, because everyone can bring this up. Doesn't always have to be the insurance broker. And so just getting some attention on this can ultimately help create some solutions for the client. And now that we have this full risk premium, we may as well use this for business planning. So if we know what the numbers are, be it now or if it's in an acquisition situation, let's use those numbers, right? So now we can understand FEMA's got an 18% increase cap on their renewals. Could go down, but it seems like that's what it's going to at least max out at for the foreseeable future. So that policy, even though 18% is still a pretty big jump, that we know exactly what we are going to see in subsequent years. And then I think, again, involving the real estate and the loan broker in the process, if either of them help identify this, then that's only going to bring more attention, to what's going on. So it kind of takes us into, attacking the insurance. This is everyone involved, right? Looking at new acquisitions, looking at renewals. When our clients have even given us an indication that a refi or sale may be coming this year, seeing this domino effect ahead of time, so you can start getting some attention on, bringing some of this to your client's attention. It's always better than when it's 2 weeks before a closing and the flood insurance is causing quite a headache. Everyone on the calls probably had one of those situations in the past. And like I said, this is for everybody. I mean, take this opportunity to clients, because there's a ton of hidden NOI in the flood zones. I talk about that a lot at conferences, because again, there's so much antiquated data that FEMA has used both in the flood maps and in their new flood insurance rating model. It's all about getting into the granular details to really make this an offensive. And then for your renewals, make it a defensive strategy, right? Take this to your clients, find them a solution that helps, lower their premium. And obviously, this is not going to be something that another agency would be able to use against you. So I think that's something that, again, use outside resources, right? It doesn't have to make extra work in your day. Use outside resources to help do some of this auditing and just help find some of these solutions. One thing that we offer to a lot of people is a portfolio review, right? So we volunteer a lot of time. The reviews that we do for clients actually have no upfront cost. So if this is something that you'd be interested in talking about, feel free to send me an email. Let me just go ahead and add that in the chat before I forget. There we go. Would help if I sent it to everybody. There we go. But a portfolio review is basically our team helping to go through all of the different policies for you, help do some of this auditing so your team doesn't have to. And it's a pretty high success ratio and percentage. So definitely, if it's something that would be of interest, shoot me an email and we can talk about that after the webinar. So jumping through, because I'm going a little bit over my time, something here that's of huge importance is understanding the difference in loan programs. So this is why not having a lender requirement really matters. So if you've got somebody that's going from like a standard loan program or maybe some short-term bridge debt to an agency debt program, so that's your Fannie and Freddie loans, typically clients are going to only have had 500,000 on their coverage, and Fannie and Freddie typically want full building replacement, 12 months of business income. And so not having to add that cost, when you can see someone's flood insurance costs go from 10 to 100,000 when they were, only covering 5 million in flood insurance total, and then having to all of a sudden come up with another 20 million that Fannie's requiring, so this can obviously be a substantial surprise for your clients. So again, if you start hearing that word refi getting tossed around as an option, and again, all this short-term debt, you should see this coming well ahead of your clients in the next 18 months, knowing when their loan programs are set to mature, and go ahead and get ahead of the curve and see, could a MAP amendment be possible and help them to just, at nothing else, maintain the same flood insurance that they've always had. Obviously, if they have a high cost and there's some way to get that number down, that's only going to help make their refinances more valuable. NOI growth equals higher valuations. So just to kind of finish up before we jump into a case study is, getting a due diligence checklist. This is something that I'm going to have sent to everybody after the webinar is finished up. So these are all things that you can go through on the checklist. The seller situation is not always the buyer situation. And easy example is if the seller doesn't have debt and the buyer goes into the transaction not even knowing that the property is in a flood zone. So I say identify the domino effect formula early, which is the number of buildings in the 100-year flood zone times the type of lending program that they're going to get. If you put those two variables together, you can start getting a ballpark picture of, okay, is it a Fannie Freddie scenario where these 4 buildings are going to have pretty high flood insurance requirements? Or is it only 2 buildings, normal loan? Okay, that's not going to be as detrimental to, to the underwriting for the property. So taking a look at some of these things and having a professional engineering firm review the flood zone 100 out of 100 times, doesn't matter how unlikely it might be. You never know what you're going to find when someone gets into the details. So it's really about how we all work together. And at all these different stages, this is a very basic depiction of, the real estate acquisition process. Of course, there's obviously lots more people involved and lots more steps, but you can kind of see where different people come into the process at different time periods. But if all of these people have the same ideology about the flood zone that, hey, we better get some attention on this, this is how communication can improve. This is how we can all help each other. Because at the end of the day, we all want to see the transaction go through for the client. They work really hard to get those deals to contract. And then it's the same for refinances. We all want to see these go through because the more we help our clients, obviously, the more rinse and repeat business that it makes for everybody. So it all starts with early detection. We'll have on the due diligence checklist a link straight to the flood map. So you can throw the address in. you can start learning how to use that map and identifying when that blue 100-year area is touching the buildings. So just a couple really quick case studies to go through and kind of bring this all together. This was a client that actually just bought a property this week. Closing was yesterday. So they had 5 buildings, and initially going in, they were unsure what type of lending program they were going to use. So it was really hard to even work with them to know what their flood insurance costs might be. And their broker didn't really have any idea either. It turns out they ended up going with a loan program that was going to have much, much higher insurance requirements. 50,000 is what they ended up with. They decided that the map amendment was something that they wanted to look at. So in going in and qualifying all 5 buildings, that's 50,000 in savings that these guys have from day one that initially, they would have assumed had to continue paying every year. So for a property like this is basically an extra $1 million in their property valuation, which is massive. So another recent client, you can actually go in on our website. We have a case study section with our project spotlights. So one of our clients out in California, he actually just went through a refinance over the summer. So this is a real example from a few months ago. 12 buildings. We helped him lower his flood premium by 30,000. And he told us that in his cash out refinance, that equated to an extra 600 grand. So he was a pretty happy person, as you can imagine. And then here's a client you probably heard of, 84 Lumber. They've got, hundreds of locations around the country. And so we met this client early last year, started going through their portfolio. They actually had 20 properties in the flood zone. We were able to help them on 13. So this one's an interesting case because they had so many buildings. As you can kind of see this one building in the lower right of the picture, it's an open air building that they're basically just keeping the rain off of those materials. Well, they had a lot of buildings like this that weren't even technically in the flood zone, but they had been flagged by a flood zone determination years ago. And, again, commonly, no one even knows to question this. So as we audited their whole portfolio, we found over 200,000 in savings for these guys. And, that's a pretty dramatic impact, even to a company of that size. So you really never know what you're going to find when you start going through all the details. And like I said, this is where, someone like us comes in, and it's one of those things like where we're happy to take a look because we know that, again, about 50% of the time, there's going to be a solution that's possible. Now, I apologize. I went a little bit over on the presentation time, so I'm going to open up the Q&A questions here. And one question to start with is, why do some carriers ask underlying questions and some don't? Maybe a tough question to answer without a bit more specifics, but what I can say is that not all of the carriers have the same level of training as the others. Now, I don't deal with all of them daily like you guys do, but, where this one's saying had some policies with an incorrect number of floors that was assumed, where other carriers have required that we give them that number. And honestly, I think this is a personal opinion, but what we've seen from just feedback and over the last 18 months is that I think some of the carriers have basically just been overwhelmed. They had too much to go through. And I don't think every policy is getting audited as closely as it may have in the past. And so I think from what we've heard, this is where you definitely see a difference from one carrier to the next, whereas some might be pretty picky about something and another one may not be. Good question there. Another question is, how do you know the replacement cost value is an assumed number? So I don't know all these off the top of my head because there's several, but like for an apartment building, for example, if you didn't input anything at renewal, that type of other residential building would automatically be assumed at 1.2 million. That was the same for several types of buildings. It's not the same for every type of commercial building. So again, if I see a policy that's 1.2 million, for me, that just tends to stand out that there was probably not an updated RCV that was used. Typically you'd expect that number to be, $1,300,020. So anyway, it's something that obviously that takes an extra step to go in and get that, whether it's a Marshall and Swift or, one of the other type options that they will accept. Somebody asked, what's a CRS discount? It's a good question. So across the country, NFIP has incentivized the communities, right? So the local counties are who really manage their flood zones and their flood insurance program participation. So they choose to be part of the NFIP. And so there is a criteria that county can go through, and they get a score essentially. And depending on what their score is and how many different things they do proactively to improve that score, that leads to a discount on the flood insurance for their local county properties. And so the CRS discount, we've seen as high as 35% in some areas of the country. And so again, it's one of those things that you can't directly impact it. The county has to really kind of do a combination of efforts. But if there's one available in that area and you're not seeing it on the renewal, that's a flag that goes up for us, and then investigating why that's not being applied and if that can be corrected. All right, give me just 1 second to read this next question. All right, it says, can you please explain the map amendment? Can we still do that? Can we go back into historic maps? So with the change that happened with Risk Rating 2.0, it really didn't have any effect on the flood maps. They're somewhat independent of each other, the flood map oversight versus the National Flood Insurance Program. Think of them as close cousins. So with the new Risk Rating 2.0, the map amendments still are happening just the same. And so nothing has really changed with Risk Rating 2.0 in terms of what lenders are requiring. All that is essentially still the same. We can't really go back and use the historic maps in any way. Unfortunately, you might see situations where you're trying to prove that, a building was built in compliance in terms of permitting, if they're having some construction issues. But really everything is using the current maps for, in terms of requirements and such from the lenders. And then just a question here, just to touch back again on the portfolio review. Again, what we do day to day is we're looking at properties all over the country, right? So that's what we do. That's how we, we'll get projects in the door. Is we do the initial review at no cost. So our engineers will go through all the data. They'll look at the flood insurance declarations pages. They'll look at the elevation certificates, topography, site maps, really get into the granular details and try to see if there's a cost saving solution that may be possible. And then at that point, it's talking to you, it's talking with the client and saying, okay, here's what the before and after looks like. And does this solve a problem? So this is where the discovery is very important, and understanding what particular real estate scenario they're in. Because again, a map amendment has lots of benefits. And it's not always about just the cost savings or just the lender. So a portfolio review is something we started doing before the Risk Rating 2.0 transition for a lot of brokerages. It's a confidential process. It kind of goes without saying, where our team will essentially take 12 months and go through all the renewals with that brokerage. And it's been a very successful process. I think it's taken a lot of stress off of a lot of brokers and having to worry about if something got missed with the 2.0 transition. And so at that point, we're just every month, we're looking at renewals, typically about 60 days out. We go through the process, and then we just give that feedback to the broker directly. And then we let them choose how they want to handle, the conversation with the client. And so it's become a way that we've helped a lot of brokerages play defense. It's been a way we've helped clients, use that to take proactive proactive cost savings to their clients. And so, of course, if that's something that you'd like to talk about, we put an NDA in place and love to talk about how our teams, can align, towards that finish line. So it's a lot of information today. And again, we'll send everyone the recording so that you have it if you want to go back through anything. So you have that with the slides. I'm going to pause for just a second. And if there's any other questions that anyone would like to drop into the Q&A, Please go ahead. All right, going once, going twice. Very good. All right, so just want to give everyone an opportunity here as well. If you'd like to schedule a meeting with someone on our team, you can use that QR code there to the left. And if you've got your phone, you can just hover the camera kind of up to the screen. It should take you to a Calendly link to schedule a meeting. My email is, of course, in the chat. You're welcome to reach out to me. I'd love to have a follow-up meeting with everybody and learn a little bit about you. I learned the most from talking to the market, talking to brokers, talking to insurance experts. And, at that point, I'm just trying to recycle information as best possible and try to present that so that everyone can benefit. The due diligence checklist, we're going to send that to you by email. But if you're curious to go ahead and take a look at that, again, that QR in the middle, and then that QR on the right-hand side, if you've got a property you'd like to send in right now, you can actually use that. You can submit it through the website, and one of our sales team, will follow up. So, for us, we're passionate about helping clients. We have the same goals at the end of the day. We all want to help clients make their properties valuable. We want to find them as much cost savings as possible. And we want to align with all of you guys to help use this as a way to grow your business, grow your expertise. So we're here for whatever you need. If you've got a question, give us a call. If it's something we can help with, great. If we can't, then, maybe we'll learn something together. But I want to thank everyone again for coming today. Taking an hour out of your day is not easy. And I can't say how much I appreciate that enough. Again, there's my email, and you can use that info at National Flood Experts if you'd like. You can use that to also send in a property to be reviewed, and we'll have one of my team follow up. And, a lot of our team really worked hard to kind of get the word out for this. So there's probably some of our team you already know, and I'll encourage them to follow up with you as well for some latter conversations. And then before you go, last thing I'll say is we just kind of updated our website. So we've got quite a few additional information that that you can kind of see that'll, somewhat mirror what we talked about today. But then there's a lot more case studies. There's a lot of client testimonials where you can really hear firsthand what their experience was like going through some of the process. So thank you so much. I appreciate everyone, and I hope you have a wonderful rest of your day.